In today's episode, I'm going to talk about the very real advantage that retail traders are currently experiencing in today's market. Right now, I feel like there's a window of opportunity that's open, and I don't know how long it's going to last. So here's my goal for you today. I want to teach you some tips and tricks that you can implement in your own trading in hopes that this helps you extract a little bit more profit from the market and hopefully reduce the size and the frequency of your losses. Trading is risky, there's no question about it, but I'm going to tell you something. Right now, there's something happening that is unprecedented. Retail traders, and this is an article that I just read currently from Robinhood, Charles Schwab, and E-Trade. Those three brokers represent nearly 25% of the total volume in the entire market, just from those three brokers. So right now, we are in a period where retail trading has come back with a vengeance. In fact, if you think back, when was the last time we saw a peak of retail trading like this? It was right before what? The short squeeze in 2021 of GameStop. The only time retail trading has ever been higher from these three brokers was back here in December of 2020, just before the GameStop short squeeze. Now, this table of data was compiled by JP Morgan, and it includes four brokers: E-Trade, Schwab, TD, and Robinhood. But Schwab bought out TD, and so they merged right here where you can see. So now, basically, the lion's share of this trading volume is actually generated by Charles Schwab. Now, we could talk quite a bit about why Charles Schwab is such a popular broker. I rank them as a 7.5 on a Ross scale, Ross score of 1 to 10. They're a great broker. They're very popular for a number of reasons. But what I think is really more interesting here is that just those three brokers alone are contributing nearly 25% of the volume in the market. Think about all of the other brokers out there for retail traders. I mean, there's a lot of big ones. You've got Webull, you've got Interactive Brokers, you've got TradeStation, you've got Fidelity. Those aren't included. And then what about all the direct access brokers that cater to active traders like myself? Some of us are trading with very large share size. We're not represented on this graph right here. So now what I'm starting to think is that retail traders may be starting to actually dominate the market. So let's talk about that retail advantage. Now, if we take a step back here, I want to just say that it wasn't that long ago, back in 2015, 2016, when high frequency trading algorithms represented over 60% of the volume in the market. As of today, right now, NASDAQ says high frequency trading volume is about 50% of the volume in the market, just the high frequency trading. So one of the things that I think is interesting is that there's a certain type of stock that high frequency trading algorithms are going to really like. And that may be, and I think it is, different from the type of stocks that we as retail traders are going to make the most money on. So what I want to do at the beginning of this episode is help kind of set the stage to help you understand the right type of stocks to choose. Now, we're going to start by looking at the type of stocks those high frequency trading algorithms love, because those are the stocks that we need to avoid like the plague. All right, so let's go full screen on this slide deck right here. Now, we will come back to this broker comparison sheet here. I will go over some things in this. I'll share with you some of my some of the highlights of some of the brokers that I think are the best for retail trading. But let's talk about the best stocks for high frequency trading algorithms. So stocks that trade in a relatively tight range allow high frequency trading algorithms to profit from the maker-taker fee structure. The way the maker-taker fee structure works is that if you have a stock, let's just say Ford, $9.50 on the bid and $9.51 on the ask. What does a market maker want to do? A market maker wants to buy 100,000 shares on the bid right here, and they want to turn around and sell the 100,000 shares on the ask right there. If they do that, how much money will they make? Just on one penny, they will make $1,000. And not only that, they will also get paid by the exchanges for creating the market, for making the market. So the goal of these algorithms, the goal of these market makers is to buy and sell equal number of shares at the end of the day and just profit from the spread. So all day long, when you have a pension fund or a mutual fund or some financial advisor buying a position in Ford to add to their fund, the market maker gets to profit from the spread. Because typically when someone comes and buys, where do we buy? Typically when I'm buying, I buy at the ask. Because when I want to get in, I just want to buy the stock. I'm going to get in right here. I don't want to sit and wait. So who gets to profit when I buy on the ask? It's the market maker. And who gets to profit when I sell on the bid? It's the market maker. So the type of stocks that these high frequency trading algorithms, which are run by market makers and institutional traders, the type of stocks they're going to like are stocks that trade in relatively tight ranges because they can buy and sell all day long without taking the risk of the stock suddenly dropping 40 or 50% while they're holding 100,000 shares, right? Okay, so number one, stocks that trade in a tight range are going to be great for high frequency trading algorithms. So we probably want to avoid those types of stocks. Well, you probably already know that because we don't make a lot of money buying a stock at 950 and selling it at 951. Number two, high frequency trading algorithms like stocks and indices that are predictable and don't experience too much volatility because they take the exposure by accumulating positions, buying from people who are selling, and then selling to people who are buying. If a market maker sells 1 million shares to someone because someone says they want to buy 1 million shares, and then suddenly the stock squeezes up 100%, the market maker is short 1 million shares, right? So the market maker can't sell an infinite number of shares, and they can't buy an infinite number of shares, and they don't want to buy and sell big positions of stocks that could experience a lot of volatility because that's how a market maker can blow up and they're gone. And they don't want that to happen. So they get paid by making the market, and they're going to do it on less volatile stocks like Bank of America, like the S&P 500, like Pfizer, and so on and so forth. These less volatile stocks. So we're probably going to want to avoid those as retail traders as well. Number three, ETFs that trade on high volume are great for high frequency trading algorithms because they can buy and sell all day long. They've got lots of volume, lots of liquidity, but they don't move all that much. So should we be day trading ETFs? Probably not. Number four, high price stocks allow for bigger spreads, which means more profit for the market makers. So should we be trading higher price stocks with bigger spreads as retail day traders? Probably not. That's number four. Number five, well-established stocks with large market caps that trade on lots of volume while trading on low relative volume are companies. They're constantly being bought and sold for ETFs, mutual funds, and pension funds. They're not good vehicles for the volatility that we crave as retail traders. So that's not going to be suitable for most of us. So this is a list, the 5 criteria that I would make for the best stocks for high frequency trading algorithms. Stocks that trade in a tight range, stocks or indices that are predictable, ETFs that trade on high volume, stocks that are higher priced as they allow for bigger spreads for profit, and well-established stocks with large market caps. So now, those stocks that are up typically less than 5%, they don't make big moves. They typically have low relative volume and low beta. Typically, they're priced above $50, and typically they have a float of over 500 million shares and a market cap of over 10 billion. So now let's flip this and say, we don't want to trade against high frequency trading algorithms unless a stock is in a complete short squeeze, in which case the high frequency trading algorithms are getting forced to cover or are turning off entirely. So that would be the GameStop scenario. But generally speaking, GameStop wasn't even a perfect stock for high frequency trading algorithms in 2019 or 2020 when it started to gain momentum, because at that time, the price was too low and the market cap was too low. So even then, the people that got caught weren't high frequency traders. It was hedge funds who were betting against the company like Melvin Capital. That's a totally different type of, that's a different type of person. So here's the retail advantage as I see it today. This right here is what the institutional traders, the high frequency trading algorithms are looking for. And this is, to me, the inverse. Stocks are up more than 30%. Small cap stocks with volatility because they have news. Relative volume of more than 5, meaning the stock has 5 times higher volume today than its 50-day average. Stocks priced under 20, preferably under 10. Stocks with a float of under 20 million shares. This is where we're getting into the real sweet spot. And this is what I found. We can simplify our process of searching for stocks each day by looking on the scanners for just simply the leading percentage gainers. So let's take a look today at our biggest percentage gainers. So here we go. Right now, we've got leading percentage gainer in the market, MLGO. Now, I'll be the first to admit that this was not a particularly easy one for me to trade today for a variety of reasons, but on a typical day, this is the right type of stock for retail traders to be looking at. The type of stock that can go up 500, 600, 700% in one day. Yeah, that's something high frequency trading algorithms don't want to have anything to do with. This is a stock today that I would wager 90% of the volume was retail traders. And how much volume was it today? 530 million shares. 530 million shares. You have billions of dollars that traded hands today on MLGO. There's that many retail traders in the market. Now, some of these retail traders have big accounts. Some of them are throwing big size on these types of positions. They're marketing in, they're marketing out. They're not all going to be easy. We're going to have to add some additional criteria, both with time of day, price, stock, and a few other important criteria to help us eliminate the stocks that are going to be a little bit more difficult and then find the ones that are going to be, in my opinion, a little bit easier. Trading is hard. There's no question about it. But like anything else, it's on a spectrum. Some stocks are going to be easier and some are more difficult. And I want to try to help you find the right type of stocks to trade each day. So here we have a stock, just as an example, that had breaking news. Okay, so this stock has breaking news, SGN, and all of a sudden, as the news breaks, what happens? Boom, the stock starts spiking. So the second the news comes out, the stock pops up right there. It pulls back just a little bit, and that first pullback for me represents a buying opportunity. And next thing you know, the stock is up, well, the previous day was $2. So when it got to 3, it was up over 50%. Goes up to 70%, goes up to 80%, 100%, 150%, 200%, pulls back up to 650, pulls back up to 7. This is a stock that went up 300% in one day. This is where retail traders can grow their accounts, trading these types of stocks. And you don't have to have a 6-figure account to be participating in this type of action. Even if you have a relatively small account, a couple $1,000s, you buy 1,000 shares of a stock at $3 and it goes to $4, $5, $6. That's $1,000 of profit for each dollar a share it goes up. So it's like, to me, this is the type of market and these are the types of stocks that I have always been attracted to as a retail trader. This is where I've been able to grow my account. So the stock scanners that I use every day are searching the market in real time for stocks that are moving. Because one of the biggest challenges that a lot of beginners face is not knowing how to find these stocks in real time. So some people will say, all right, I need to trade a stock that has breaking news. So I guess I should spend all my time just reading all the news headlines. That's not going to get you anywhere. Because the problem is you can spend all day on Yahoo Finance, but everything you see there is going to be you're going to be behind the ball. You're going to be late to the game. By the time you're reading it there, the move has already happened. And a lot of the headlines that come out don't end up meaning anything. The stock doesn't do anything, even after that news comes out. So rather than spending my time reading and combing through all of these news headlines or subscribing to super expensive news feeds, what I do is I use this type of scanner right here. And of course, I have the scanners that we've built at Warrior Trading, but even if you use scanners that are available freely on Robinhood or Webull or something like that, there's some basic scanners out there that'll show you the stocks that are the leading percentage gainers. And so now all of a sudden, you can get focused on trading stocks that are volatile, that are moving. So what this scanner does is it tells me right here at 9:39, boom, SGN has the flame, which means it has breaking news. It's $3.71. It's got 4 million shares of volume with a 292,000 share float. That's the number of shares available to trade. So the supply is very low. The demand is very high. It has 95 times higher volume today than its 50-day average. It has 36,000 times higher volume in the last 5 minutes than during a typical 5-minute period. And it's already up 91%, and it has a short interest of 110,000 shares. Based on a float of 292,000 shares, that's a big deal. This is the type of stock that can make a move. And so the way I approach it is when I see a stock like that hitting my scanners and popping up, what do I look for? The first pullback. So as it squeezes up and it pushes higher, as you see right here, I let it pull back, and then I look for it to basically, this is what I look for. The squeeze up and then pull back. Now, if it pulls back more than 50% of the initial move, I say, all right, I can't really trust it because it's retracing the whole move. We call that a round trip. So it goes up and then comes all the way back down. What that tells me is that Once traders had a chance to actually read the news headline, they don't like it and they're saying, nope, I'm not going to trust it. And this is really important because in a hot market, what often happens is traders jump first and ask questions later. So stocks can pop, and then once traders realize what the news is, they're like, ooh, that's not even good news, I should get out. And it can have a big reversal, and then short sellers come in at that same moment. So what I like to do is I like to let the stock pop up and then let it pull back just for a moment. And now prove to me that you can hold 50% of the gain. I expect a little profit taking after a nice move, but it has to hold that 50% line. And if it can hold that line, then I'm gonna buy the first candle to make a new high right here. Because the way these stocks typically move is they move in waves. A wave up and a little pullback. Another wave up, another pullback, and then another wave up. I like to trade the first pullback, and then I like to trade the second pullback. So this is right here the example of that really nice clean breakout where it just takes off. Now the psychology behind this pattern and the reason that it works is because a rapid move up attracts retail traders. Now, if just the top 3 brokers, and actually I don't even know if they're the top 3, but if just E-Trade, Robinhood, and Schwab represent nearly 25% of the volume in the market, when you factor in all the other brokers out there, retail traders are really taking a position in the market that is probably a bigger percentage than we've ever had before. And retail traders hunt for volatility. So when a stock starts popping up, you've got a lot of people now who, boop, 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 all of a sudden, they're seeing that stock. They realize it's got news, and now the supply on a lot of these stocks is relatively low. The float, less than 10 million shares, it's not a lot of supply. But right now, today, in this market, there's a lot more demand from traders who want to try to capitalize on that move. So now you've got more volume, a bigger imbalance between supply and demand, and that's where we're seeing these bigger moves. Like today, seeing MLGO squeeze up over 700%. That's incredible. So the rapid move up attracts traders, and now there's more traders in the market. This is especially true when the move is driven by breaking news. The first pullback is formed by a little profit taking. People may be holding before the news came out, maybe some early short selling. But if it holds 50% of that first leg up, long bias traders begin buying that pullback. Shorts cover at high a day as the price makes a second push higher. I typically buy the first pullback, and then I profit as it moves up, and then as it pulls back a second time, I buy the second pullback, and then I take that next trade higher. I don't usually want to overstay my welcome. So the issue today with MLGO was that the first pullbacks were way back here. This is where we had the first pullback and then the sort of second pullback, and it pushed a little higher, then it pulled back for second day continuation. Then in this area, it became a little bit choppy. Shorts got caught and it squeezed up, which was nice, but it became very volatile. And unfortunately, you could see these high volume red candles, which were big rejections. So what that was telling us is that both long bias traders and short bias traders were getting caught. A lot of emotion was coming out. And now this was like sort of the epitome of fear and greed. People were feeling fearful that they were going to miss the move, were jumping in, and then afraid they were going to catch a loss and were getting back out, and then getting back in, and then getting back out, and then back in and back out. And that is not as easy to trade. These are almost always easier to trade at the beginning of the move and early if it's a second day continuation. But as it goes higher, this is where we really can expose ourselves to a lot of unnecessary risk. So I'm a big advocate of being aggressive at the beginning of the move and then not overstaying my welcome. So I'm going to give you a pop quiz. Look at this pattern right here. Should you buy this setup right here? So we've got a stock that has just made a nice move up, right? 2, 4, 6, 8, 10, 12, 14, 16 green candles in a row. It's pulling back right here, bottoming tail. The MACD is open, high volume buying, light volume selling. This is something that we like. And there you go. That's that rally from 360 all the way up to 460 and pushing higher. Here's another one. So what do you think of this? First pullback, second pullback. So right now we're on our second pullback. We're looking for a move higher on this. Nice. From 299 up to 430, 440. And what we're seeing is these types of patterns playing out again and again and again. So here's what I'm going to tell you. Right now, and I think a lot of other traders feel this way, there's a window that's open. And I don't know how long it'll be open, right? This article that I saw from CNBC, now I was really most interested in the article because of the fact that they cited JP Morgan, and this was legitimate market data. So this is the actual market data, and so I can interpret that in my own way. The headline is Trump enthusiasm matches GameStop mania as small investors flood the market in record numbers. But it's overall a negative sentiment on the article because they're talking about how retail traders are dummies and they're going to buy dips, and then eventually dips won't work and they'll lose all their money. So I'm going to interpret this a little bit differently. I'm going to interpret that there's a lot of retail traders right now coming into the market, which is a fact. And rather than just assuming that they're all going to be idiots, I'm going to assume that some of you guys, like me, actually want to figure out how to do this the right way. Here's the deal. I've been trading for a long time. I funded my first account in 2001. I started my small account challenge in 2017 with less than $600. As of the end of 2024, you want to know how big that account was? I started with $583. Let me pull up my audited broker statement for you. Now, some people say, Ross, well, I see this all the time in the comments. Ross, you should really get your profits audited. You should really show your broker statements. I do. The broker statements are always on the website right here. This is just last month, but you can go and you can look at all of these years of broker statements from 2017 through 2025 right here. And this is the audit. This is an independent accountant's report verifying that I turned $583.15 into $12.6 million. I'll be the first to tell you my results are not typical. I've been doing this for a long time. But what I can also tell you is that if you want to learn how to trade, I think it makes a heck of a lot of sense to learn from someone who's in the trenches every day. And I'm here every day. You can see this is the last, 7, 8 years of me showing up every single day and trading. Bear markets, bull markets, I'm here. So I think there's a lot of traders that want to learn how to trade the right way. And this is what I would encourage you to do. Focus first on A quality stocks. Because you know what a lot of beginner traders do? A lot of beginner traders jump into the market and they're overconfident. And what do they end up doing? Well, let's pull up the whiteboard. The first trade, they've got money in their account, and what happens? They lose money. What do they feel? Sad. Out of that sadness, what do? They increase the quantity of trading. Why? Because they want to make back the money they just lost. But they have no idea what they're doing, and so what happens? They lose more money. That's going to be $2 signs. They lose double money. And then they're even more upset. And then they increase the frequency of trading even more, and this is a downward spiral. Now, some of you maybe are in a downward spiral right now. I've been in downward spirals before. And so I'm going to tell you from my own experience, the way to break out of that downward spiral is to focus on A quality stocks. Stock selection is number one, because when you focus on high quality stocks, what happens invariably is that your accuracy improves. It improves because you're no longer subjecting yourself to the unnecessary losses that come when you trade stocks like Ford or Bank of America or large cap stocks that are dominated by high frequency trading algorithms. Those are not the type of stocks that retail traders are going to tend to make money on. So when you spend your time trading them, you get sucked into the market, you're studying the level 2, and what happens? You end up losing money. So let's take a step back. Let's focus on stocks that meet my 5 criteria for stock selection. Number 1, stock should be priced between, ideally, let's break it down right here. Ideally, I'd like to trade stocks priced between 2 and 20 with a preferential, sort of focus on stocks between 3 and 5. I want to trade stocks that are up at least 50% on the day. I want to trade stocks that have a relative volume of at least 5 times their 50-day average. I want to trade stocks that have news, and I want to trade stocks with a float of under 10 million shares. Now, I'll trade stocks sometimes that are 15 or 20 million, but this is what I really would like to see every single day. And now I'm going to give you a plan. So here's the plan. Every day I sit down at 6:45. My goal is to be locked up with profit, hard stop, 10 a.m. Now, if you want to trade longer, by all means, you could trade longer, but that's the window that I like to be the most aggressive in. 6:45 Eastern Standard Time to 9:30, 10 a.m. Price 2 to 10, 2 to 20, focusing on biotech stocks especially, with the floats of under 10 million shares, focusing on news like FDA approvals, clinical trial results. Stocks are on the scanners, and focusing on buying that micro pullback. When you focus on trading the right stocks, accuracy improves. When accuracy improves, your profit-loss ratio improves. As your profit-loss ratio goes up, your consistency goes up, And now you're building a strong track record. As you build a strong track record, your confidence goes up. Increased confidence leads to increased trading, and now you are on a positive feedback loop. So here's what I want you to do. I want you to begin by breaking the cycle right now if you've been trading low quality setups, and look at the scanners every single day and ask yourself which stock today is obvious. Now, if you want to watch over my shoulder while I'm trading, I will put a link. It'll be pinned to the top comments and linked in the description where you can do a 2-week trial at Warrior Trading. You can watch over my shoulder while I'm trading live. You will see my positions window in the top corner, so you'll see when I'm in a stock, when I'm out of stock. You'll be able to hear my real-time market commentary. And essentially, you're getting a first base coach. You're getting to piggyback off of all of my years of educated intuition. Now, I'll be the first to tell you, trading is risky and my results aren't typical. But I think if you want to learn how to trade, it makes a lot of sense to learn from someone who is proven profitable and is showing up every single day in these markets. So let me give you a little bit of perspective here. If we take a step back here, I'm going to show you my profit just over the last 90 days. In the last 90 days, I'm currently at just over $2 million in gross profit. I have a goal this year of $5 million. It's an aggressive goal, but I think it's achievable. With what we're seeing in the market right now, with the dominance from retail traders, if we have a couple of big moves, realistically, when I think back to 2020, there were a small handful of days that contributed nearly 25% of my profits for the entire year. Days where I was up $200,000 in a single day of trading. So a $5 million goal for this year is $20,000 a day. Pulling that out of the market consistently requires being very disciplined about trading the right stocks each day and knowing when to walk away. So if you want to learn to trade, if you're ready to take the leap, I would love to have you join this 2-week trial starting anytime you'd like. But of course, I'll be live streaming Monday morning. So 7 a.m. Eastern Standard Time. Get logged in, and I hope to see you in the chat room. I hope you guys enjoyed this quick episode, and I'll remind you as always, trading is risky. My results aren't typical, so please manage your risk, take it slow, and I'll see you in the chat room Monday morning, 7 a.m.